All right, I'm going to continue diving a little bit deeper into investment performance and some of those areas of return. I already mentioned the areas that I dive the deepest into. I want to put all my time, energy, and resources and people into certain areas that I think are going to make the biggest impact. Now, the first one I talked about was intrinsic value. When setting the allocation of the portfolio, intrinsic value to me is my number one area of understanding. And a couple of reasons. Number one is it's based on real numbers. This is the financials of the company in the past. Here's all the estimated financials in the future. Would this be a fair price to pay for the stock? Yes or no? It's all right there, and we know yes or no. And great companies, you can say this is an awesome company with everything I want about the company. It just happens to be way overpriced at the time. Now, there's still things you can do. It's just understanding what's the right way to create ownership in that company. And also, are we overvalued or undervalued? Pretty important with taking gains off the table and maybe holding some bonds to reduce some of the risk. Not everything's learned from a textbook. I've referenced this book quite a bit before. It's called Richer, Wiser, Happier. And it references a lot of what would be Warren Buffett's strategy. And it talks about intrinsic value pretty deeply. And I've mentioned this before, but it's a very common theme that these very successful investors have used intrinsic value and all the ways that they determine when they should buy, different business cycles. It's a great book. Recommend reading it if you like that type of thing. But I've read it multiple times, and I truly believe that can tie and learn from what the best have already done with understanding this is how we use intrinsic value for investing. All right, number two is stock selection. This is something over the last 22 years where I've been looking at stock, trying to determine what are the best stock. And it just comes down to, you got to have an deep understanding of finance, but you have to know the company. You'll be surprised how little that you can truly know until you do everything. And I say this, just not me, it's like every group, the person I'm talking to, like to know that company as deep as we possibly can, where you're actually maybe inside, visiting the company, being part of the earnings call, all those things. Because I've had so many times where I've been, like I mentioned Ben before, a CFA that's helps with our inner team working with our investment strategy. That's a mutual fund allocator, or excuse me, a hedge fund allocator. And it would be, what about this company? And then he's like, that company is not going to fit. And it would be reasons that I wouldn't even know because on paper it looks good. So you got to know the company. Now, another thing when it comes to stock selection is I want the strategy to be unique. As an investor, you have big companies coming to you. And the company is like, we have all this proprietary investment strategies that give us, these are our recommended 10, 20 stock, whatever it might be. And all this work and research has been done to it. Well, okay, that can be good, but that same work and research is going to millions of people. Like what element of uniqueness am I going to have? It's probably just going to be very close to whatever the market is going to be. It's not that I'm personally able to get into these stocks at the price that I want to and have a unique portfolio centered around the investments and companies that I think are going to be the best. I just personally find that the more unique the strategy can be, the better. Another thing that I've witnessed that I believe that and philosophy behind like being unique is important. Number three, the options market. The first note I make is it is all about the stock. An options contract has to be tied to an underlying investment, and most commonly it's tied to a stock. If you don't know the stock, you should not be in that options contract. When people said they have not done well in options, which many people don't do well, it's because they don't understand what's going on with the price and the type of options that will be associated with the price and the overall long-term nature of their investment strategy. So you have to know the stock deeply before owning an options contract on it. And then I wrote down I don't know if I can say it any other way, but people can just be greedy. They're trying to get too much premium or they're trying to take too big of bets one way or another. Options markets, if you're doing one of those two things, you're probably not going to end up very good. So if you take what's given to you and are very conservative and not greedy and use options to what they can be, then that's where I find the true value and why I like the options market so much. And then private markets. Private markets, I just didn't have as much emphasis as I did the first three, just mainly because so many people are kind of cut out of the private markets. Private equity is an example that they're trying to make more mechanisms where people can be in private equity. a private company, you can get better valuations. You can ultimately have higher rate of return because of what's called liquidity premium. And all that means is it's long-term and you can't sell it. So if you can't sell an investment, you should get higher rate of return. Another thing, and understanding the CFA level 3 curriculum, the 2005, it has a private market section. And a big reason why people get into private markets is that you get exposure to a business cycle that no one else gets to. So there's certainly good reasons to own them, and I really find it fascinating to evaluate them. But it's long-term, meaning that you can't sell it, and the market fails or that company fails, you're on the hook. It could go to zero. I mentioned size. Is you might need $1 million just to invest into one private investment. You have to be an accredited investor. You have to have so much money. I've never hardly seen anything that's less than 100,000 that you need. So you need to have a lot of money before you qualify for private markets. And then risk is that like the investment can go to zero. You can't sell it. So there's significant risks with holding private investment. But if private investment is done correctly, one thing, it could be setting money aside. If this money goes to zero, not going to affect me financially at all. Another is that I really truly believe this company. I think it's an excellent company. I want to be a part of it. Let's invest money into it. Those are all reasons that you need to take into consideration. So again, those are 4. I just want to dive a little bit deeper on some of my views and philosophy behind those 4 when it comes to performance evaluation.